Good afternoon, everyone. My name is Kent Kramer. I'm the Chief Investment Officer at Foster Group. We're a registered investment advisor with offices in West Des Moines, Iowa and Omaha, Nebraska. And we've taken to kind of do a weekly update here at the end of busy weeks. This is the second week that most of us have been working from home. I'm sure many of you are working from home also. We're living in very interesting times. And while I wouldn't want to make light of it because things that are going on are serious, it is amazing to look at what's happening around us and to think about all the historic things that are happening that many of us will look back on and go, that was an amazing year in 2020 that we lived through and invested through and worked through, and all the things that we're having to change as a result of social distancing and the things that are becoming part of our regular language from day to day and week to week. So here we are at the end of kind of our second week of really that social distancing or trying to stay home, work at home in different parts of the country. And I thought maybe we just start off by looking at the financial recap of the last week, because a lot of things happened this last week. And if you're like me, these weeks seem like they take a long time. Last Sunday seems like a long time ago, but it was just last Sunday that the Federal Reserve announced that they would be buying up to $680 billion of bonds in the span of 1 week. That amount was the entire amount of the bond buying program in the great financial crisis of 2008 and 2009. So they were going to put a lot of money, a lot of liquidity into the system to support credit markets, which is what we talked about last week. Last Friday, we were talking about some of the behavior of bond markets. This was designed really to smooth out bond markets, as we'll see in a minute. They were largely successful this week in the way that they deployed those dollars. As a result of that, the Fed's balance sheet today holds more bonds than it did at its highest point post-great financial crisis. So what that means is quantitative easing, kind of round one and round two, when the Fed was buying lots of different bonds, what happens is the bonds that they buy, they become part of what's called the Fed balance sheet. And the value of that balance sheet is now higher than it was at any point after the great financial crisis. And the likelihood is that they will continue to buy bonds to support bond markets. And that both supports borrowers and lenders, because we need the credit markets to function for people to be able to continue to lend money, and for those people who have borrowed money to not be forced into repayment at an inopportune time in the midst of an economic crisis like the one that we're in right now. Chairman Jerome Powell was on the Today Show this week in a rare interview, and he put it this way: when it comes to this lending, we're not going to run out of ammunition. That doesn't happen. Only the Federal Reserve can say something like that. They have basically a blank checkbook, and in combination with the U.S. Treasury, they can provide liquidity as much as they want. And they're determined, I think, to do that, to make sure that credit markets continue to function well, that those credit markets should not be the cause of the thing that brings an economy down. They're going to make sure that that's not the case. In addition, then the federal government kind of stepped in starting around Sunday and Monday. We saw a large stimulus bill working through the Senate, and then the House proposed their own version. By the end of the week here, the Senate had passed a stimulus bill that totaled a little over $2 trillion of impact. The House then took that up today, and they passed it. I saw right before we went on with this webinar here this afternoon, and the president is expected to sign it. He's indicated all week that he was waiting for Congress to go ahead and come to agreement and get it to his desk so he could sign it as quick as possible. That $2 trillion, if you compare it to 2019's U.S. gross domestic product, or GDP, that number in 2019 was $21.4 trillion. So the $2 trillion in that fiscal stimulus bill is 1/10 of U.S. GDP. That is a massive amount of stimulus. It's the most ever passed by the U.S. government. There are actually multipliers in that bill that could take the stimulative impact from 2 trillion to as high as 4 to 5 trillion. So there was a lot of things that happened this week to inject financial confidence into the markets in terms of liquidity and money coming to individuals and companies to make sure that the economy will survive however long we need to remain kind of shut down or in this social distancing slowdown area to make sure that public health purposes are served well. U.S. stock markets reversed their negative trend based on these news with 3 consecutive positive days. There hadn't been 2 consecutive positive days since February 2nd. And the bond markets, as I mentioned, did return to a more normal functioning as the Fed entered the market. And let's take a look at that here. This chart I ran earlier today, and it just shows some different investment measures within the United States. The blue line is the aggregate bond index, which is tracked by Bloomberg. And what I wanted to show here was when you see kind of a week ago, what was happening is the bond market was generally kind of declining and starting to come back up at the end of the week. But then right going into the week, right here, you can see that blue line start to really go up. That's when the Fed came into the market and started buying bonds. So they supported the bond market because they saw this happening. And in normal functioning times, when equity markets are declining, bonds generally are increasing because interest rates should be getting lower. That wasn't happening for 5 or 6 trading days, and that's usually a sign of credit duress. We talked about that last week. The Fed chose to address that with their bond buying program. It seems to have really steadied things out. And this week, you actually see what you hope to see is a more level line. Bonds are generally a lower volatility, less risky asset. That's why we want it in portfolios. These other 3 lines are just represent measures of different parts of stock markets. The black line is the S&P 500. The purple line here is U.S. small companies represented by the Russell 2000. And this orange line is actually publicly traded stocks outside of the United States. So I thought it was interesting to see that over the last 10 days or so, actually, foreign stocks and small company stocks have outperformed U.S. large company stocks a bit, though that's really something new that hasn't been the case for a couple of years. But in general, the point here is all markets had an incredible week coming off of that close on Monday. Once the stimulative package was known, you can just see what happened here. That first day on Tuesday, things went straight up out of the gate. And then we kind of trailed up all the way through the end of the day on Thursday with an adjustment down today, which is really pretty understandable when you think about this historic change in markets so quickly. Here's a picture of just how historic that volatility is, or has been this week. This is a picture of rise and fall in the value of the S&P 500 on a daily basis for the year so far. And what you want to note here out on the right-hand side is just the extreme valuation changes in equity markets from day to day. And here are those 3 positive days. Bloomberg put this chart out this morning before today's market close, but you can see what happened here. We were in a full-on bear market, meaning we had declined more than 20% from the market high on February 19th. And by some measures, just in these 3 days, we actually exited that bear market. And what that means is once we get into a bear market, if the stock market reverses and rises 20%, you've exited the bear market and you're back into a new bull market. That was true for the Dow, not necessarily true for the S&P, so it'll be interesting to see how we refer to this period right now. Now, today things went down a little bit again, so we may just adjust and say, oh, I'm not sure we're really out of the bear market, but we certainly had great performance in the latter part of the week, and I think that was a welcome sign to many people. So with all that activity in equity and bond markets, one of the things that we've been talking about as a firm, and many people ask about regarding their own portfolios, regardless of who's taking care of them, is, hey, when should I be rebalancing? Or is this a good time to buy equities? And how would I know when to maybe sell bonds and buy equities? Because the idea is successful investing, you should be hopefully selling high and buying low. And rebalancing is a disciplined way to accomplish that idea. What I've done here is I've put up a picture of markets going through the great financial crisis. And the reason I wanted to take a look at that is because when we think about when is the best time to buy or to sell, when is the best time to rebalance the portfolio, what you'll see here is you really don't know when the best time to do that has been until after the fact. So if you were thinking about your portfolio back in 2007, 2008, and you were thinking about rebalancing, once the markets went down about 20%, right here, this first blue arrow, you might have been thinking, well, bonds are relatively positive, equities are negative, maybe I should rebalance now. You could have sold bonds, bought stocks, but it might have felt disappointing had you done it at that point, because you know what, from this 20% point, equity markets actually kept declining another 20, and then some equity markets went down even before that. So things were down almost 60% by the time markets fully reversed in the great financial crisis. So there were a variety of different rebalancing opportunities here. And what you have to ask is, well, which one was really the best? Well, the best rebalancing opportunity turned out to be March 8th. Because on March 9th, markets largely turned around and started to head back positively. We only know that in retrospect. All along the way, these looked like reasonable times to rebalance because equities were worth far less than they had been just a few months prior. Bonds were continuing to go up, which is exactly what you would have expected. So for managing portfolios, people who are doing this on their own and thinking about rebalancing, and professional money managers who are talking about rebalancing, they would have wanted to be selling these bonds while they're relatively higher than stocks and buying the stocks while they're on sale. The other thing I look at this chart and I want to point out is the opportunity to rebalance wasn't just as the stock market declined, because the stock market kept declining, reached its low point here. But relatively speaking, all these equity markets, and these are just different equity markets around the world. There's US companies, there's foreign companies, there's real estate companies, there's all different kinds of, there's emerging markets. I wanted to show this picture to show that not all markets kind of move down or back up in lockstep. So there are various different times when rebalancing would be a perfectly reasonable thing to do. The point here is that rebalancing is not a precise activity. What you want to be doing when you're thinking about rebalancing your portfolio is you want to be aware that bonds are generally performing better in times of stock market duress, and you're going to have lots of opportunities to rebalance the portfolio, effectively selling things at a high point, buying things at a low point. And that's going to be positive for your portfolio in the long term to do that, because you're following this discipline of selling high and buying low. I'm going to show you another chart here in a second, but the thing I want us to take away from this one is, in a time of really market duress, there's quite a bit of time or opportunity when rebalancing can be very effective. So what does that mean for the market that we're in today? Well, what I've done here is I've just taken a kind of a 60-40 portfolio, and my 60% in stocks is just invested in the S&P 500. My 40% in bonds is just invested in that Bloomberg Barclays Aggregate Bond Index. And what I have done is I said, well, that $100,000 invested, 60% in stock, 40% in bonds, here through the end of, basically the end of March, I've taken the actual returns over different periods of time, calculated what that means for the value of the stocks in my portfolio, what that means for the value of the bonds in my portfolio, and then it tells me, hey, where am I most out of balance on the bond side? So what you would expect if stocks are declining in value faster than bonds is that at some point, if my target allocation was 40% for bonds, at some point that allocation to bonds is going to be a larger percent. Stocks are declining, so they're worth less than 60% of my portfolio. Over here, bonds are holding their own, maybe going positive a little bit. So now they're worth more than 40. I'm out of balance. If my target was a 60-40, and I picked that 60-40 because I had a financial plan that said that was the right kind of combination of risk and return for me, what we do with rebalancing is we say, okay, well, we're going to take opportunity then to rebalance the portfolio, to sell bonds, buy stocks in this place, in this event, and that's going to bring the portfolio back to the risk-return balance that we had in mind for a financial plan at the beginning. The nice thing about this is by rebalancing, doing it in a disciplined way, you are selling bonds while they're relatively high. They're worth more, relatively speaking, than stocks are at the time because they're declining. The reason I like this kind of graph is what I've done here is I said, well, through 325, stocks were down quite a bit. You can kind of see we had a negative percentage here in January, a little bit positive through February 19th, the market high, and then we went down. And this is just the change in return over each time period. So from the high on February 19th, stock market declined almost 13% by the end of February. Then by March 20th, it went down another 22%. And then through the end of the day on Thursday, it had gone up another 7.4. Actually, this is on Wednesday, another 7.4%. So the point of the chart is over here, we're just looking at, well, what did that mean for the balance of my portfolio? And what it meant was I had more than 40% in bonds. The math just makes sense. When we look at this, what we see is if going forward, let's say that March 20th was the bottom of the market, and I'm not saying that at all. I think there's a lot of economic things we've worked out between now and when we know that this is over. But let's just say that it was, and stock market went up on average 5.5% per month coming into the next 4 or 5 months. What that would mean is our balance, which is now about 48% out of balance, would move to 44%. So today, or beginning of this week, I had about 8% more in my bond portfolio than I wanted, 47.8 if my target was 40. If these percentages are in the ballpark, and there's no way of saying that they will be, but this would be a very positive event in the stock markets. This would mean we're coming out of this really fast. Given that, we have a lot of time to rebalance. We had some time last week where rebalancing would have been effective. It still would be effective now. It would be effective next week. It would be effective in May. If any of these things are even remotely close to what markets might do. If markets go up slower than this, our rebalancing period will just extend even longer in terms of that opportunity that we have to rebalance. And all the rebalancing would do is it would just do the math and say, well, if I want to get back to a 60-40 portfolio, on March 25th, I would have needed to have sold $6,000 of my bond portfolio and bought equities with that. That would have brought me back to a 60-40. You can kind of see in this column for bond sales, these dollar amounts are the amounts that would have had to have been sold to bring the portfolio back to a 60% stock, 40% bond balance, bring it back to that risk return profile that you as an investor had chosen. Whatever it is, whether it's a 60-40, 80-20, whatever, it's just a matter of doing the math between how far out of balance I am, selling the appropriate amount of bonds, and buying stocks with the proceeds. That brings it back to our 60-40 portfolio. So where are we? That's really a great question. This is the picture of those same markets that we looked at earlier through basically the end of the day today, right near the end of the day. And you can see that we've declined all those equity markets, U.S. large companies, international stocks, small U.S. companies are all down for the year, somewhere around 20%, maybe a little bit more. The idea here is you can also see how bonds began to kind of level back out. That Fed buying program was really working, bringing them back up this last week. And the idea is, hey, we have the opportunity to rebalance here because we're down here in the equity market. Have we reached a bottom? Will March 23rd prove to be the trough of the market? Have no idea of knowing. I think that you could have asked the same thing right here before this jump. You could have asked the same thing right here before this jump. The idea is it's very hard to know until we get well past this period of time where the bottom had been. However, just remember from our picture that the opportunities to rebalance will likely consider for weeks and months ahead. This picture that we're looking at right now is really showing things in terms of weeks and days. We think back to 2008, 2009, the window of rebalancing there was for months. So this feels like, wow, we need to act with urgency or act quickly. But the normal kind of affair is that this is going to take a while to work itself out. If that's really the case, we most likely have months to get through a good rebalancing. We won't know when the perfect time to rebalance will have been till long after the fact. But the idea is for investors, they should be really seriously considering rebalancing right now, because no matter what, we do have an opportunity to sell some things at a relatively high point, bonds, and buy things at a relatively lower point, stocks. So just a couple final thoughts on rebalancing. One to remember is rebalancing is primarily a means to manage the risk in the portfolio. We're trying to maintain that stock to bond ratio. That's what any investor wants to do. They've chosen which risk profile suits them, what's going to provide the most expected return for the amount of risk that they're willing to take. And you want to keep the portfolio managed to that risk profile through careful rebalancing. Rebalancing may enhance the return of the portfolio. Remember, rebalancing is a discipline of buying things while they're relatively low and selling things while they're relatively high. If we do rebalancing on a regular basis, it's just a discipline, kind of takes the emotion out of whether I think I should be buying or selling. It just says, if there's a significant spread, if things are out of balance, I'm going to rebalance the portfolio. The other thing to remember about rebalancing is it's imprecise. There's really no way to know when the ideal time to rebalance the portfolio is going to have been. One, because in a diversified portfolio, you have so many assets, they don't all reach the top or the bottom at the same time. The other thing is there's really no way to know where that bottom or top is going to be until months, maybe years after the fact, when we look back and go, oh, that would have been the ideal day. Now we know, looking back at 2008 and 2009, that March 9th of 2009 would have been the perfect time to rebalance. We didn't know that looking forward. We didn't know it on March 9th. Anybody who was around at that period of time, in March, people were still feeling like, will this ever end? It just happened that that was the day that it did, that it turned. And had anybody rebalanced prior to that, a few weeks prior to that, that would have been great. Had anybody rebalanced a few months post that, would have been great too. Would have been good for their portfolio. They would have been selling high and buying relatively low. Last couple thoughts here. There's plenty of people kind of still talking negatively about different things. One of the thoughts that's helped me the last week, something I read by an author who I like very much, Morgan Housel. He was writing an article about the positive effects of stress. And one of the things he said about this time, you can see him here on the screen if you're watching, he said, capitalism, or he writes, capitalism works because profit is an incentive to improve. When the incentive becomes survival, literal or financial, that force goes into overdrive. The biotech industry today, medical industry today, there are lots of people who are doing all kinds of research to see if they can't find a cure for COVID-19, effective treatments for the virus. That will continue to go on because two things. One, survival is necessary. If we're going to survive, we need to have success in learning how to treat this thing and get past it. But also the financial reward for people who do a good job of discovering treatments, vaccines, all those kinds of things. There's a great deal of reward out there for people who are really focused on finding a solution. And that kind of goes to the second part of the quote. The most important innovations are born from panic-induced necessity more than cozy visions. And if you think about that, when people are comfortable and there's really no reason to work hard or to think creative thoughts, not much new happens. When people are uncomfortable, they're under a great deal of stress, we will apply our creativity to find a solution. There are thousands and thousands of people who are working very hard to creatively find a solution. I've thought really from the beginning that there are going to be things along the way that are going to be surprisingly good news. I know we're closer today to hearing some of those good news than ever. Don't know exactly when they're going to happen, but I'm confident that they will. As humans, we've risen to the challenge many, many times before. I expect that'll be true this time as well. So with that, I'll sign off. Hope to see you next week, and we'll talk more about what's happening in markets then. Thank you.